All right, let's begin. Your next assignment is due on Wednesday, and that includes the break-even problems where we are talking about break-even between profitability and losing money. So that's one kind of break-even that we talked about on Wednesday of last week. And then on Friday of last week, we talked about break-even between alternatives. And just very briefly, I'll refresh your memory about that by going over the template file that I emailed out earlier this morning and also posted on Blackboard. This homework assignment also includes a payback analysis problem, which is related to the material from today's class, and we've actually done this on two prior occasions where we calculate the unrecovered investment balance over time and gradually look at how profits in the future can be used to bring down the initial purchase price of the equipment in terms of when are you finally going to break even and make your money back that you'd invested. Homework 12 also has a problem related to putting winglets on an airplane. Has anybody already looked at that problem? Trying to save money by improve the fuel efficiency of an aircraft. And that's not related to any of the break-even type procedure I've showed you before. That's just a general problem solving, an algebra type problem where you're looking at the future value of some cost savings. Because if you make some upgrade to the airplane, then it's going to cost less in fuel. And then you're comparing that to the investment price for the upgrades you're making to the aircraft. So I just wanted to mention that that particular problem isn't related to a payback analysis or a break-even problem. It's just considering some of the same questions, like in terms of finding the present value of the profits. Also, you've got now 11 days for the project. That's due Friday of next week. It's kind of amazing to think how far we are in the semester already. So check this out. There's this week, and next week, and then the week after Thanksgiving. And we've only got 3 weeks of classes remaining. And of course there's the exam week, and then there's Thanksgiving week itself. But in terms of instruction, we only have 3 more weeks of instruction. So we're definitely deep into the semester at this point. So any questions on the announcements? All right, so before we talk about the payback analysis, let's just take a quick look at the template file that I provided you today. So that's here in our class page on Blackboard. If we go into the Student Start Files / Excel templates, it's the one at the bottom, break even between two alternatives. I've downloaded it and we'll open it now just to refresh your memory on how you can use this and what the components of cost are. So in this break even between alternatives, you're considering two options. One option that's cheaper to purchase at the beginning, but more expensive to operate on a unit basis. And then option 2 in that example was more expensive up front, but cheaper to operate on an hourly basis. And so you had to begin with some guess value of output. I think in the problem it said, at 1,000 units per year, then you'd find out what is the costs. And the costs include how many hours you had to operate the equipment. And so there was a description of the productivity, which is how many units per hour, how many units you can generate per hour of operation. And so at the bottom, we come up with the total cost, including the two components, the cost of purchasing the equipment and then the cost of operation. And we wanted to know the difference between the two alternatives because at one point our goal was to find out how many units makes the difference between costs equal. And that's the break-even point, when the two options equal the same thing. And if we go back to visually what that looks like, there was this slide that shows us the equipment that's cheaper to purchase initially, but this line is steep because it's the option that has a higher cost per unit of operation. But then this alternative 2 had the taller intercept because it's the initial purchase price, the fixed costs, if you will, are higher, but the costs of operation are lower. So the crossover point where these two curves interact, where they intersect, that is when the total costs are equal, so the difference is 0. Okay, so that's just to step you through and refresh your memory about that template file. Now, let's change gears a little bit and think about acquiring equipment. It could be construction equipment, it could be computer equipment, anything that you have to purchase that has a big upfront cost. So let's say that this particular steamroller has a certain acquisition cost, and we're going to be obtaining that equipment by taking out a loan at a certain interest rate. So it doesn't matter exactly what the number is, but there's some initial acquisition cost, a given interest rate, and then the purpose of buying that equipment is that it enables revenue, that you're going to be getting money for using the equipment that you wouldn't have otherwise been able to acquire that money. So the question is, how long does it take to pay off the equipment? And you're paying off the equipment taking into account the interest rate. And it's the interest rate that tells you how much less valuable in the future the income is compared to the dollars that are spent to acquire the equipment at the beginning. So we want to find out how long does it take to pay off the loan. And so we've seen this kind of analysis in the past, and you've seen this figure, for example, where on the vertical axis it showed the unrecovered investment balance, and starting at year 0, you had a certain amount of money that you paid to acquire equipment. And that line is up, even though normally when we spend money it's a line down on a cash flow diagram. But this isn't a cash flow diagram. This is a figure that's illustrating something else. This is illustrating how much money haven't you got back yet from using the equipment. And so at the beginning, at time 0, however much you paid to acquire the equipment is how much you haven't gotten back yet. And then during the first year of operation, that amount increases because of the effective interest. So now not only is there the initial acquisition cost, but then also the interest that accumulated in the first annual period. And then the revenue minus the expenses, so your net profits, bring that unrecovered investment balance down a certain amount, and this cycle continues until finally the equipment is paid off. And so in that previous example, we numbered the columns, and I gave you a little formula that told you how to calculate each one of those columns. So we've seen this idea of unrecovered investment balance, and when it finally goes down to 0, then the equipment is paid off, and any subsequent use of the equipment after the equipment is paid off is profits. So just some terminology that we're going to be using today. The payback period is how long it takes to cover the initial investment plus a given rate of return. And what you're covering that initial investment and rate of return with is the net revenue or cost savings. And so when you're spending money that otherwise, when you're reducing expenditures by, for example, if you're purchasing insulation for a building, and then that saves money that was going to be used for heating the building, then that is considered as revenue that justifies the purchase of the insulation. So if you're going to do a payback analysis on fuel efficiency savings, then it's the initial purchase price versus the savings over time that you're trying to find the balance point for. How many years of operation does it take? Simple payback is when you're just ignoring the time value of money. And we won't do that, but if interest rates are low and the time period is relatively short, then simple payback maybe isn't a horrible way of handling things. But when interest rates aren't 0%, or when it's a longer time horizon, it's really important for us to take the time value of money into account and discount those future revenues at the interest rate I. And then we want to find out how long does it take for the present value of those future profits to equal the initial investment. So how would we use this analysis? We've talked about decision criteria on several occasions this semester, and how, for example, the decision criteria on benefit cost analysis is that if the ratio is greater than 1, then the project is potentially justified. So that's an example of a decision criteria. So the decision criteria in payback analysis is we can only use this for initial screening to find out if the equipment is potentially suitable. We can't use payback analysis to identify the best alternative if we have multiple options. So payback analysis is just useful as a thumbs up or thumbs down, and what we would say is that if the useful life of the equipment is greater than the payback period, then that's potentially justified. But then think about the reverse. What if it will take you longer to pay off equipment than you'll have to use it? Then that means that you're essentially losing money, because the whole point of purchasing the equipment in the first place is that you're using that equipment to generate new revenue. So if you haven't yet paid it off with the additional revenue that's being generated, before the equipment breaks down, then you're still making payments on the equipment even after you don't own it anymore, it's not in service, and it's not generating revenue. So if the payback period is longer than the useful life, then the equipment is not suitable. As comparison, like comparing two alternatives, we have to be really careful with payback analysis. If you have two pieces of equipment that have the same useful life and they're able to generate the same revenue, then you'd choose the equipment that can be paid off the quickest. And usually that would arise just because it has the lower costs of operation. And one of the interesting things about payback analysis is you're just fixated on a time, the number of years. So like the equipment can be paid off in 7 years, for example. But what the payback analysis doesn't look at is what happens after the equipment is paid off. There could be that the equipment suddenly becomes a lot more expensive to operate after it's owned. And think about if you're comparing a Mitsubishi to a Honda. So those are both Japanese cars, but Honda has a reputation for maybe more durability and a car that's going to hold its value for a really long time. So if you could pay off both cars in 5 years, that doesn't necessarily mean that the two options are equal, because even though they're both paid off after 5 years, it's possible that the Honda, over the longer term, has lower operation, lower repair costs, and so it could be the superior option. So you have to be careful about how you use payback analysis. It's just looking at part of the equation. A few of the alternatives, a few of the considerations that it is blind to would be those things that happen after the payback period. Like maybe a piece of equipment holds its value because it has a lot of metal, or there can be some equipment that has gold or platinum in it, and so it could still have a pretty high salvage value that the payback analysis wouldn't necessarily be able to see. All right, so in today's in-class exercise, this is number 33, we're going to be looking at a piece of equipment that has an anticipated useful life of 18 years. Now, I've provided on the handout a 8% table on the back side of the handout, I think. The 8% factor table, because our MAR for this is 8%. And the equipment's present cost is $92,000, and it's generating an annual net revenue of $11,000. So the first thing I want you to refresh in your mind is that you can, just by looking at the factor tables, find the crossover point from non-profitability to profitability by looking at the ratio. So let me pause for a second, and after you go through in this hand calculation part with the table, then fire up Excel and create a spreadsheet with the following column titles: year, amount, PV of amount, and then unrecovered investment balance. And that unrecovered investment balance is the same meaning as it's had on prior occasions, and if you don't remember how to solve it, it's the previous year's unrecovered investment balance plus the present value of the inflows for that year. So I'll demonstrate that in just a moment. So you should work on A and B together, and then we'll take a look at the solution together. So the first part, A, you do with the table lookup factors, and then the second part, B, you're going to use Excel. All right, so P is 92,000, A is 11,000, and so the ratio of P divided by A is 8.364. All we have to do is go to this table and find the P to A column, and when the P to A column is too low, that means that the equipment isn't paid off yet. So we're looking for at what point does the ratio cross over to being more than 8.364. And so that means the value of the annual revenue compared to the initial purchase price. So you can see that it's too low, and then finally it crosses to more than 8.3 after 15 years of operation. So that means 14 years of operation isn't quite enough to pay off the equipment and justify its purchase, and then 15 we're above the unrecovered investment balance is positive. So, you know, it's discrete annual increments that this revenue comes in. So we go from being too low to being too high. We didn't like exactly get zero unrecovered investment balance at one of the years. So it's going to be, the answer is you have to do 15 years of operation to justify the equipment. 15 years. All right, now let's set this up on Excel to verify that approach. And the column titles, as it's mentioned, we need to have year, amount, PV of amount, and then unrecovered investment balance. All right, and then up at the top is where we define the interest rate as 8%. Let me just make these columns the right width. Okay, so at year 0, we spend $92,000 to buy the equipment, and that's an outflow, so I'm putting the minus sign there. And then we need to have, it never really tells us what the useful life of the equipment is. Let's just look at it over a 20-year horizon and see what happens over the course of 20 years. Now the amount after that is our net revenue of $11,000. So the $11,000 in net revenue through time. And we need to find the present value of each of these by discounting it at this interest rate. So we can use the PV function, lock into the reference on the 8% interest rate. Pressing the F4 button gives me those dollar signs, comma. Now for the number of periods, it's just our time because we're taking it from the future to the present. So the further forward in time we are, we want n to be larger. Okay, skipping over the payment field because each time it looks at that cell, it's going to treat it as just an individual amount that's in a given year that it's discounting to time 0. So I skip over the payment field and then minus of this amount, and it sees it as a future value. Oh, I don't like that formatting. Let me change all of these formatting to currency. And then I'm going to take away the cents because I don't necessarily need to see that by decreased decimal. All right, so 92,000, and if I drag that down, you can see that the 11,000 1 year from now has a value of 10,185 if you're discounting at 8% per year. So each one of these $11,000 revenues is becoming progressively less valuable in present terms. So the unrecovered investment balance is initially, it's just the initial cost of the equipment. So it's the equipment itself. So 92,000 is how much we spent up front, and we haven't yet recovered any of it. So the next year is the previous year's investment balance. So I'm referring to the cell above plus the present value of that year's revenue. So the reason why we had to do this PV of amount column is we want to combine dollars together in the same time frame. We want present value dollars to be combined with present value dollars. And those future value dollars, we couldn't just have it be with the 11,000 itself because those future value dollars aren't as meaningful as the money that was spent earlier in time because of the effect of inflation. So I can just continue this trend downward through the entire time period. what we see is that it crosses over from being negative. So you see the unrecovered investment balance is negative, but getting less negative, and then finally it crosses over to being positive in the 15th year. Excuse me. All right. So any questions? That validates what we had found here, 15 years. So we're just seeing it this way as well. Any questions? Okay, there's one other function that the in-class exercise introduces. It says that you need to try using the Nper function. Okay, so down here at the bottom, let's try out the Nper function. Oh, maybe to the side. That way I can still be here. So equals Nper. Now we've done all sorts of functions. We've done the present value function, the future value function, the PMT function. This function is just solving for n. So we've had functions where we solve for the present value. There's been functions where we solve for an annual equivalent, where you're solving for a. That's the payment function. This Nper function, you're just solving for n. So first of all, the rate. So I could type this in or refer to the amount. So I'll just type it in. 0.08 is our rate. The payment, okay, so our payment amount is $11,000 each year. And the present value, negative $92,000. And it's going to find out how long it takes to pay that off. Now my future value, that would be if there was some salvage that I had to take care of at the end of the lifespan, but there's not. It's just a present value and a payment, and what it solves for is 14.37 years. All right, so we know this is happening in increments, and so to be fully paid off, it takes 15 years. So that verifies the crossover point that we'd identified here. So this was, it's always good for us to put annotations. This was solved using the Nper function. So any questions about that so far? All right, so I want you to get a little more practice. In part 2, you're comparing two pieces of equipment. So do the unrecovered investment balance. So same as I've just done here. Do one for machine X and one for machine Y. And you don't need to change the interest rate. That's still 8%. But you'll notice the service life here is only 7 years for machine X and it's 14 years for machine Y. So you need to have 2 cycles of machine X. So remember the repeatability assumption that you have the least common multiples. So when you're setting up your cash flow table, do machine X where you're purchasing it for 12, you're getting 3,000 in revenue, and then at the end of the cycle, you're buying it again. So there's going to be 1 year where you've got both 3,000 in revenue, but then also a second purchase price for machine X. So do unrecovered investment balance for option X and option Y, and then we're going to look at when is there crossover points, like when do they go from being unprofitable to profitable. All right, so let me demonstrate the solution on here, and you can keep working, of course, if you're right in the middle of it, but I'm going to do this matchup of machine X versus machine Y. I've got to go through a 14-year time horizon because both pieces of equipment need to be compared over the same duration. So that means I start off by buying the equipment for $12,000 with option X, and then I get $3,000 in revenue every year that it's in use. But then in year 7, I have to buy the equipment again for its second time around the block. So I have both the revenue that year and also the purchase. So the net difference between the two is a $9,000 outflow in year 7. I do the PV equation. All right. And unrecovered investment balance is the initial purchase price for the first year. And then for the second year, it's the previous unrecovered investment balance plus that year's revenue. Okay, so let me drag that down and then quickly reformat these cells because I don't know why I'm so fixated on it not being in red with those parentheses, but I am. All right, so it looks like it's paid off in the 6th year, but kind of not really, because then you have to buy it again to get through the rest of the cycle. So really, it's not paid off until the 10th year. In reality, like when you're comparing apples to apples, machine X, let me label this as machine X, machine X, and then I'm going to have it merge these cells and it centers it. So then just to make it more clear that it's referring machine X to these ones. All right, so there's machine X, and then over here I'll do machine Y. And rather than typing those all in again, I'll just highlight that and then paste it, and then I can also paste the width of the cells. All right. So the amounts for machine Y is an $8,000 initial cost, and then $1,000 in, what did it say, our sequence of, so $1,000 in years 1 through 5. So here's year 1, 2, 3, 4, 5. But then, for whatever reason, this equipment really starts to get useful and generates $3,000 a year for the remainder of its life. So $3,000 in years 6 through 14. Okay, so I'll find, let me just wrap this, give it a border. All right, PV amount. Unrecovered investment balance is for the first year just that amount, and then for each subsequent year it's the cell above plus the new revenue that's coming in this year. So when do we finally pay off machine Y? It gets paid off after 8 years. And so here I'm going to put a conclusion. For machine X, it is initially paid off after just 6 years of operation. However, we have to buy the equipment again to cover the full 14-year cycle. And so for that full cycle, the equipment isn't paid off until the 10th year. In contrast, machine Y is paid off after 8 years. All right, so if we do that kind of comprehensive analysis, that suggests that machine Y is the better option. Because when you look at the full time horizon of 14 years, then machine Y has the earlier break even, because here's our 10-year break even on machine X, but 8 years to break even on machine Y. Any questions about this first part? Okay, now the last part is it says that we should calculate a present worth analysis for both machine X and machine Y. So let's find the present worth of each of these. So there's a couple of ways we could do it. We could do the NPV function using just the raw amounts that haven't yet been converted, or we can just add up the PV of the amounts. I'll do that. So I'm going to do sum of PV. So if we add up the sum of the PVs, what that tells us is that the 2 equipment cycle of machine X has a present value of 5731. So that's how the present value of our net profits if we go with machine X. And machine Y, the sum of the PVs is, let's see, 8747. So I guess up here I never said, conclusion is choose machine Y. That was the result of our analysis here, is that Y is more profitable. And this also confirms that. Let me put the note in. Machine Y has the higher net profit in present value terms. Choose machine Y. So both of these analyses are pointed in the same direction. Machine Y looks better because it's paid off more quickly, and it's also better because the present value of its profits is higher than machine X. So we feel pretty confident in our recommendation that even though it looks like machine X can be paid off more quickly, that's kind of a false indicator, because once we consider the fact that you'd have to run 2 cycles of it, it's actually not paid off more quickly. So machine Y is what we ought to purchase. All right, well, that is all I have for you. Let's just take one last look at these announcements. That homework 12 is due before class on Wednesday, and the project is due Friday of next week. All right, I'll see you on Wednesday.